I've never heard of one not paying, and I can't find any evidence that one hasn't paid.
Courts are very deliberate in giving all benefit of the doubt.
The courts usually rule in favor of.
You're listening to Remnant Finance, the show that brings you unfiltered takes on unconventional strategies to sever your dependence from the banking industry and Wall Street.
We're Brian and Hans, military pilots turned economic insurrectionists and infinite banking practitioners.
Now back to the show.
Welcome back to Remnant Finance. Still in the alert shack there.
Ready to save the country at a moment's notice.
Yeah.
I'm always ready to go fight a war that doesn't exist for a cause I don't believe in.
Yeah, that's it. That's what we did I did for about 14 years. You're still doing. I had a conversation with a buddy. I mentioned him before. He's the one who, smartest guy I know in the Navy, can't not say the truth, like even if it means making your boss look bad. And so it's been, in the officer world where it's very, the boss walks into the room and everybody smiles at his terrible jokes. And then you see your boss smiling because the admiral's in the room, and it's a very kind of kiss ass sort of culture, at least in some respects. He doesn't play the game, so he's just like, I'm sorry, Admiral, that doesn't make sense. If we do that, it's not going to work. I don't know what to tell you, but this was a bad idea that you had. Like he's that guy, and he's right, but people would rather be, not rub the boss the wrong way than say the truth. And so anyways, he works at the budget office essentially for naval aviation, and he has been describing the people that he works with and how there's a whole cadre of civilian staff that just doesn't show up. And when he asked, hey, why do I never see you? And they said, well, the first half of the month we work 4 hours a day, and the second half of the month we just work from home. And he's like, no, that's not going to happen because we're so far behind on everything we're doing. Our office, like, we're failing at everything. Like, you're going to come in. And he got essentially promoted to whatever. And I said, every time I talk to you about this, and I think most people in the military can relate, we know how much waste there is and how instead of increasing the budget to $1 trillion defense budget, it should be slashed in half. I said, ironically, like if your office was firebombed and the aviation budget office didn't exist, it would actually be a net positive for the budget, because this is just such a cesspool of waste and people that are going to be earning double tapping pensions that just sit there and do nothing. And it's like, if the numbers don't work on the budget, you just change. It's like there's no wrong answer because no one really cares and there's no actual oversight. So it was really funny talking to him about that, and it brings to mind the conversation we've had before, where like you could just do away, I think, with half the military, and it would be a net positive for both defense, because you'd actually have to focus on priorities that matter, and it would just save so much money. But anyways,
and just efficiency of like not having to deal with people that are just a drag on production.
Yeah,
easily. Maybe not 50%, but I bet you, if you think of the old like Pareto principle, you could easily drop 20% of any workforce in any different sector of people wearing uniform, and it would be a net positive to the unit. Just dropping that 20% that creates 80% of the problems. And I don't know how far you whittle that down, because, if you do the multiplicative effect of that, like the next 20% creates the next 80%, which really comes out to like 64% of the problem is created, by 4% of the people. But so if you just kept doing that, it's like, could you slash, keep doing like further iterations of that and get to slashing almost half of them and have virtually no problems.
Yeah, we and now with AI too, honestly, I think it's like the inverse of the Pareto principle now. Like, I think you could slash 80% personally. But when I was a flight instructor, we used an Excel spreadsheet to track the progression of students. And it was like a legit masterful spreadsheet. And it was called the Barnyard Tracker because the guy that created it like 10 years ago when I was there, that was his call sign. And so it was like, we all just referred to Barnyard, but if there's like one glitch in the spreadsheet, it was does anyone still know how to reach this guy? Is he still around?
Yeah.
We also have this flight logging program called Sharp, where you keep track of logbooks and flights and everything. And there's one guy, Juan, who was the like West Coast Sharp representative. And this is like 19, or maybe I'd say like maybe 2005 era technology. it's a pain to use. It's inefficient, but it just dominates your life as a flight instructor, filling out all these sharp reports and stuff. And there was just one guy, and it was like, oh, Juan's on leave right now, so we're just going to have to sit and wait a week and let these logbooks pile up before we can do anything. And now all of that can just go away. But of course, like, rather than saving the $150,000 that guy makes as a contractor and the second pension he's working on, we're just going to keep him on because you can't hire. It's impossible to fire a contractor because of the nature of government contracts. And so it's just, it's the opposite of what we're going to talk about today, as far as just efficiency, responsible management of a business. It's just stark contrast. And I think that most people that have been in the military, especially if you get towards higher levels and out of the operational side and kind of seeing some of the admin side, can certainly relate to. But what we're going to talk about today, the life insurance industry and the life insurance contract. I'm going to read a message that I got. I trimmed it a little bit, so it's not word for word, but basically the general take is, we all have a bad experience with an insurance company, and we're mostly thinking about property and casualty here. Most people, my car insurance claim didn't get paid out, or they said it was worth $5,000, but I should have been worth 12, whatever. So if the industry has this bad rep, what's so different about what you guys do? Why would I trust insurance? Is it all in the same package? So she said, how certain concepts are named the same, therefore put in the same category, then all lumped together as good or bad. Like nuclear, you could have nuclear bombs, but you also have nuclear energy. It seems like insurance is the same, deliberately confusing. We hear about and personally experience people having valid insurance claims and the insurance company finding every loophole to not cover. And because of them rarely paying out, which I don't know that rarely is the right answer, but frequently enough that we all have an experience of it, because of their rarely paying out, insurance companies are the wealthiest business, wealthier than banks and even countries. It seems very scammy. And then I'll read through the whole comment or the whole question here. But is this statistic of wealthiest companies because these are well-established life insurance companies that have full reserves, not like fractional banks? So they are indeed wealthy because they are responsible and always follow through. Should these well-established life insurance companies be categorized the same as other types of insurance that people are forced to have coverage with, but are scammy and not paying out? Lumping them all together, is that like, so that is the essence of what we want to address today. And I want to bring in the contract law aspect of it, because I think when we understand the elements of contract law and how they're applied, particularly in life insurance, it should erase any fears you have of, I've had a bad experience with an insurer before. So first off, initial thoughts. We'll kind of go point by point.
Yeah, I was gonna say that's a lot of questions. I wish you would have read my my input there, but you were too smart. We're working on a shared Google Doc, so I threw in some extra verbiage, and I'm wondering if he would just straight up read it, but he skipped it. But yeah, let's go point by point here. That's a lot of questions, kind of a lot of things at once. So how certain concepts are named the same and therefore put in the same category, it's all lumped together. So yeah, that is a bad thing. And insurance agents, I think in general, when I just talk broadly across, if I paint with a broad brush and say insurance agent and insurance in particular, the insurance agents give insurance a bad name, and some of the policies and some of the behaviors of the insurance companies across the entire spectrum of insurance certainly give the industry a bad name. So that she's got a good objection there, I'll call it, and saying, like, in her comparison with nuclear, like, not all things are nuclear, like fission and fusion bombs were totally different, for example, but most people have never heard those words and they just think it's a nuclear bomb. As an easy example with the bomb, not even talking about energy, which is so powerful. So yeah, she's absolutely true. And the first thing that came to mind when you were talking about like insurance claim payouts, and I was thinking about this when I was looking at, doing all the things within your house to be for all the household goods you have with our new property insurance after we moved. It was just like, well, I want to, do the whole filming of video and uploading it, recording everything we have. And I looked into that little section of my property insurance called contract. And it's like, I could buy something, let's say a safe I have that. So let's say I bought this safe for $1,000 and we end up having a fire in a few years, and the safe has a fire rating for so many hours, but let's say the safe fails and it has to be replaced and everything inside of it. Well, they're going to value not only the safe itself, but the things inside of it. And then they're going to look at the depreciating cost of that. And that's what they pay. And when you look at that, you're like, first off, they're going to tell you what they think the depreciating cost is, and then they'll pay out a certain amount. But if I were to replace that safe that I bought for $1,000, it now costs $1,500. So that in general is like a standard practice of most insurance. And it ticks everybody off because you never come back to the value of what something's worth. And before we even get into the contract stuff, like when I think about life insurance from a dividend paying company, which is the only one you should use from a mutual company, as a mutual owner, you share in the profits of the company. And those profits, if your agent taught you what to do with it well, buy more paid up additions. Those paid up additions increase the value of the claim on your life, the value of the death benefit. So even before talking about the contract, which I agree with you, super important to get through that, this is in a wholly different category, because at any point in time when you die, if you have good dividend paying mutual insurance from a mutual company, your death claim should be higher than when you started. It should be increasing the longer you live. And nothing else does that in the insurance world that I'm aware of. Not saying that's a hard and fact truth. There could be something out there that will increase, and it might be the way you set it up and the way you pay the premiums. But in general, everything else is depreciating, whereas the value of your life is appreciating according to dividend paying whole life insurance. So that jumped out at me, and I know it's not in the contract side you want to go to, but I think it's an immediate and maybe not so obvious separation of life insurance, whole life insurance, compared to other insurances, just to start.
Yeah, exactly. And again, it's not it's not an element necessarily of the contract that we're focusing on, but we made the case before that something like car insurance, homeowners insurance, and even term insurance, those are things that you either have to have or want to have, and you hope they don't pay out, right? Nobody wants a claim on their term insurance unless you somehow pulled a fast one on underwriting and you're terminally ill and you basically misrepresented yourself, which we'll get into. Other than that, nobody wants a claim on a term policy. It just means you died young. Nobody wants to total their car, assuming that they don't overinsure the car, right? So a lot of these principles, when we're talking about, they kind of come together in the idea, and I can see why people have bad experiences if you're forced to get car insurance and those continue to go up every year. Your premium keeps increasing. When you file a claim, your premium goes up again. Like, there's a lot of things that I don't like as well as a consumer of car insurance, for instance, homeowners insurance, and I have term insurance as well. And so those are things that are matching possible events with a payout. Whereas when we're talking about whole life, and a major distinction we need to make is that we're matching this guaranteed event, i.e. our death, with a guaranteed payout. If I know for certain I'm going to total the car, if I know for certain my house is going to burn down, then I want that payout to match. And so that's what we're doing. We're taking this guaranteed thing. But the question in this comment is, okay, I get that on principle. Yeah, I'm going to die. Therefore, I want something that is going to pay out, and that is whole life insurance. But the question more is, well, okay, that sounds good on principle, but I don't have a good taste in my mouth from insurance companies. And so what if they just don't pay out? And that's more what we want to address today, is some of the background of contract laws that applies to life insurance, and then the elements of a contract itself.
All right, so let's jump into that. I'm kind of just reading through her comment again to see the next thing we should jump on before, if there's anything before the contract, like just to talk to her, like if you were having a general conversation without the data behind you to discuss the contract.
Okay, so it seems like insurance is the same, deliberately confusing. We have these personal experiences of companies not paying out. They're looking for every loophole, and that loophole aspect of it is a good one to talk through. So we'll cover that for sure. And then with them rarely paying out, is that why insurance companies are the wealthiest business, wealthier than banks and even some countries? Or, as she asked later, is it because they're actually well run, because they actually have to maintain reserves? So the elements of having to maintain reserves, not being part of the fractional reserve banking system, the stringent oversight and regulation, all of that stuff is stuff we've covered before, and we can hit on it again. But as best we can, I want to try to stay on the contract side of things.
Just to cover the one thing she says in the part that you just read, or their company, about the wealth of these companies. And it says, should these well-established life insurance companies be categorized the same as other types of insurance that people are forced to have coverage with, but are, maybe potentially scammy and don't pay or try to avoid paying claims? I have looked into this because this was a claim when I first got into the industry that people said all the time. And I looked into it. I even did the ChatGPT deep research model, and everything I looked on the paper side and the historical things of the companies through ChatGPT, I can't find any cases of actual whole life insurance where the premiums were contractually paid as promised on your side of the contract, where a death benefit didn't pay. other than some of the contractual provisions that we're going to talk about in the first 2 years where that could happen if you misrepresented some things. But after the post 2 years or with no misrepresentations, I've never heard of one not paying, and I can't find any evidence that one hasn't paid. It might be out there, but I haven't found it.
No, and I've looked for that as well, and I've
Yeah.
read that in basically you'll see that in just about every book you read on this, including the textbooks. And this gets into the history of how this is treated in court. But real quick, when we talk about we're going to separate life insurers from other insurers and why are insurance companies so wealthy, one thing I'll say is that I do invest in 2 different insurance companies, and shout out to Joe Withrow in the Phoenician League. Part of his well-researched, curated list of stocks that we talk about are some insurance companies, because think about how it is objectively a profitable business model. If you need to have insurance on these items, or most people want to have insurance on these items, and you pay the premium hoping you never pay out, never have to actually have your house burned down, never have to go through that, you don't actually want to total your car. Well, in the same way, we always talk about how profitable term insurance is for the company, because 99 to 98, 99% of policies don't ever pay out historically. Well, then they're keeping that premium. Once it expires, once you outlive your term, once you sell the car and cancel that insurance, once you sell the house and no longer have that insurance, you don't have anything to show for that. That was just a cost. And so the company gets to keep 100% of that. That's a very profitable business model. Now, there's a need on the consumer side, or there's a law requiring it. So it makes sense why these companies are so profitable. And I invest in some property and casualty insurance companies because it is a very profitable business model. Now, there is some market forces that would keep, if a company had too many bad claims, eventually, like there's some, I guess, regulation through just word of mouth and market. But at the end of the day, people shop for the cheapest. If you view car insurance as a necessary evil and you want the cheapest you can get cheap coverage, and you're probably going to have these experiences we're talking about here. I have USAA and pay more than I could. I've shopped around. I could pay less at other places that advertise aggressively, but I've had great experience with the USA. I've never had an issue that wasn't immediately resolved better than I would have expected. And so I pay a little bit more for that. I've never had one of these stories. I imagine if you just go to like whatever, like the general online quotes and get the cheapest thing you can possibly find, not saying that it's right that you got bad coverage, like that they didn't, they're picking apart the contract or whatever, but there's an element of like, you get what you pay for. And so coming back to how the courts treat this is the big thing here, is that this is hundreds of years old. We're talking about early 1700s. Initially, the idea of insurance, we're talking about marine insurance. And there's a good example in my textbook here about the difference between warranties and representations. But just before we get to that, in general, courts are very, very deliberate in giving all benefit of the doubt to the policy owner and the beneficiary. Insurance companies prefer to go in any kind of court system where there's not a jury, because they know juries are against insurance companies. Like the reason you're asking this question to the listener who asked this is because you have an experience like this. Most people do. And so most people on a jury are going to have negative impressions of insurers. And so the insurance company is the one with the burden of proof in every case. And part of the elements of the contract is that the insurance company writes the contract. You don't get to negotiate the terms. You can either accept it or decline it. But because of that, you have an expert writing, it's the insurance company, experts in their job writing this contract, and a consumer who hopefully is educated but doesn't necessarily have to be. Once they sign the contract, if there's any dispute in court, the courts lean so heavily in favor of the policy owner who could be seen as being taken advantage of, that centuries of case law, like developing law where they continue to, it's not like it's not a legislative law that's set by Congress or anything, like states regulate insurance. And so over centuries, there's been so many cases that have built up this case law so heavily in favor of consumers, which is why we can confidently say that no whole life policy beneficiary has ever not been paid out, even if a company wasn't able to pay them out and went bankrupt, which is rare due to the oversight and regulation these days. But throughout history, there is not a case of default on there.
Yeah, and that jumps down. Like I'm actually looking at our notes here because we took some notes to make sure that we don't miss things. And if I jump forward, there's a blurb in here about warranty, and I think that covers that pretty well. And you made that note, so why don't you talk about that a little bit?
Yeah. So what used to be, there's warranties and there's representations, and what used to be a contract used to be considered to be all warranties, which is essentially, you can kind of think of it as like a black and white statement that is part of the contract. It's guaranteed by the maker to be true in all respects. versus a representation is a statement made at the time of a contract that induces a party to enter a contract. It itself is not part of a contract. So the example is maritime insurance, and this isn't the legal aspects of life insurance textbook here. So maritime insurers the policy would condition the coverage on the existence of favorable state of affairs. For instance, the policy would warrant that the desired conditions would prevail. The frequent wars during the 18th century made it highly desirable that British merchant vessels sail under the convoy of British warships, and it was customary for marine insurers to require an insured vessel to sail under convoy or pay a higher premium. If a ship owner warranted that his vessel would sail only under convoy and then permitted it to sail alone, his coverage would be nullified, right? And so that is a warranty in that case is a black and white thing. If you don't, it doesn't matter your intent. It doesn't matter if plans changed and the warships that you were supposed to sail with couldn't or whatever. It's a binary. If that ship that is insured sailed alone and it was a warranty in the contract that they would sail with armed warships, the policy is void. It's not necessary for the insurer to prove that the breach, which was the failure to sail with the convoy, materially increased the risk. Materiality was assumed. Neither was it necessary to establish bad faith or fraud on the part of the insured. The insurer had only to prove that the warranty was breached.
Before you go on, a modern example of that is a lot of group term life insurance, or like for a lot of our audience, servicemen's group life insurance, SGLI. The seatbelt clause is exactly that. If they find that you died in a car accident without wearing your seatbelt, they can choose. They don't always do it, and I don't know of a lot of cases where they do, but that can be a warranty where you violated that. If you died in a car accident without a seatbelt, they don't have to pay the death claim. Mm-hmm. And so that's always briefed. When somebody's incoming and they sign up for that insurance, like that is always discussed. At least that's the way I've always learned it. So that's like a modern example of that. That's the modern example of the British convoy.
Yeah, and let's compare it to a representation, which is something that at the time when the contract was being formed, it was something that was stated by one party that contributed to the contract, but it's not considered itself a part of the contract. So for instance, if you've filled out the application for insurance with us before or with any company, do you intend to travel abroad in the next 2 years? If you say no, previously under the warranty, which is what initial contracts were, I mean, we're talking hundreds of years ago, but initially a life insurance contract. And when you hear kind of stories of insurers trying to get out of contracts, it's because they could say back in the day, these are warranties. They said they're not traveling in the next 2 years. And then they actually went over to Spain a year later and died. And so they said black and white, they wouldn't be there. And so compare that to representation, which is, do you have any plans or intend to travel in the next 2 years? And if you say no, and that's true, then the only way that could ever be used if you were to travel and then die overseas or something is if they could prove that, one, you knew you were going to travel, mm-hmm. Two, you intentionally misrepresented it. So like that's the same. And it was actually material to the contract. Like if you had told them, hey, I'm going to go take a vacation in Spain in a year, would they have declined the contract? No. And so they would have had to shown that we would have, and that's, you couldn't use that as an excuse, but like, if it was more like something, are you planning to join the military and you already have a contract as a fighter pilot, for instance, or a SEAL? SEALs can't get insurance, right? So you might be, in that case, if you misrepresented that you said, I'm not planning to join the military in the next 2 years, and they found out that you were, let's say, two different examples here. I'm going to join the Navy as just like go on a boat versus I've already got a contract to be a SEAL. If you might have misrepresented yourself and said, yeah, hey, you said you weren't going to join the Navy, but in fact, you did join the Navy and you were on a boat. Had we known, the company would have to prove, had we known, would we have denied his coverage? No, we would have given a naval officer or Navy enlisted coverage if they're going on a boat. But a SEAL, on the other hand, they could say, not only did you misrepresent and you were already contracted to be a SEAL, had we known, we don't insure SEALs. Special forces can't get coverage. Right. In that case, not only was it misrepresentation, but also had we known the truth, we would have not issued the policy, and therefore now we can actually get out of this contract. But that's sort of a difference between a representation. It has to be true at the time of application, at the time the contract is made, but it doesn't have to be true the whole time afterwards. And afterwards, for the company to challenge it, they have a high barrier to actually challenge that to void the contract. And so there's now, based on hundreds of cases over centuries now, of cases going against the insurer and almost always defaulting to the policy owner or beneficiary, there is now a clause that is required to be written to some degree within the contract that basically says statements by the insured are representations. They're not warranties. And that stems from companies trying to get out of these contracts by saying, he told us he wasn't in the Navy and he actually had signed a contract to join. He told us that he wasn't traveling overseas. He told us that he didn't smoke cigarettes, but we found out that he had one cigarette at a party and then he died. So it's like, black and white trying to get out of a contract that way. So like in the past, there has been reason to think that of insurers, but the overwhelming case law has moved so favorably in favor of the insurer that that's not even really a problem anymore. And even things that you put this will lead from here into the contestability window, that aspect of it, but the tendency has been continuously in favor of the insurer, to where now everything you put in there is considered a representation and not a warranty. So it's not like you can just void the contract because of something you said wrong. And then even that, after 2 years, beyond that, so like that example of the seal, even after 2 years, the contestability window, it's like that. So it's like, again, that's another measure where you give the company a window, and that's this incontestability window for 2 years. They can look back and say, hey, had we known, would we have changed our answer? Do we have proof that it was a misrepresentation? If I didn't intend to join the SEALs and then I decided to after this contract went in force, that's not voidable. But if I knew and had a contract to join the SEALs, for instance, that's voidable. So again, it's so hard for the insurer. Their bar is set so high, and it gets higher and higher to actually try to get out of these contracts. So you should feel some assurance of this. So let's talk a little bit more about the contestability window.
Well, yeah, and but that's why, like, the application, when we do a policy review before somebody finally signs the contract, like, it might be, it varies company to company, but it might be 150 pages, and we always, you don't really get to review, because we've already reviewed the application, but the application is an actual part of the entire contract, because then if something should happen in those first 2 years before the incontestable period we're going to talk about, they can look back at the application and see the representations you made, and use that, because you signed it as a legal document. Use those statements to do some research and see, did you have a known misrepresentation in your application process that would have, where had we known the actual truth, we wouldn't have insured you. So that's why that is actually a part of the contract.
So the definition right here, like just the simple definition, is a provision in the insurance contract that waives most of the insurance company's rights to dispute the validity of the contract after a certain period of time. That's in its simplest form, and typically it's 2 years. We're going to refer. It doesn't have to be, but almost every state has aligned on 2 years being the window here.
Yeah, and so there's a whole bunch of things that, like, I know whenever I'm doing a policy review and like you go through the separate sections of the policy, like there will be, for example, if there's an attached rider, every rider will have the exact same verbiage for the incontestability clause. And so in those first 2 years, they can look at a whole bunch of things. I think the one that's easiest to talk about is the suicide clause. Mm-hmm. So if you were to commit suicide, and a lot of people misunderstand this because I answer it all the time, they think that if you commit suicide or a person commits suicide at any point in time, their insurance is payable. It's only not payable for the first 2 years. And it's really, I like to think of it as an exercise in mental health. Like, very few people who are probably having suicidal thoughts have a 2-year stay of action. They don't have the mental stability to do that. So I think that's part of the 2 years. So if in the first 2 years a person commits suicide after signing a term or a whole life insurance contract, they can contest that, the insurance company, and not pay the death benefit, because what frame of mind were they in? They asked the questions about those sorts of things. You likely were not in a good place. But after 2 years, like, anything can happen. People can have serious mental health issues. There can be a trigger in their life that occurs that causes them to have a mental spiral and become suicidal. Well, that wasn't the case if you applied 2 years prior, that you were in that state. So after 2 years, even in the event of a suicide, the death benefit will pay. The claim will pay 100% of the time. And so they have to look at this window, because life changes too much after 2 years. I just think that's the easiest one to talk about, how long it's contestable, because it makes good sense when you think about mental health. Very few people remain in the suicidal state of existence without making an attempt on their own life for 2 years. Yeah. So it's a pretty good timeline to be like, hey, they were okay. This happened later. We would have insured them because they were healthy and they were mentally healthy and mentally stable at the time of the contract being signed. But there's a whole bunch of things in that 2 year period that they can look back on, like misrepresentations of age, misrepresentations of health is a huge one. So I always tell people, like, if something happens and you suffer a heart attack and pass away in 6 months, and we want this because, to go back to the original thing, the original person's questions about these companies being viable, when an insurance company goes under, it's for a lot of different reasons. One of them is that they're lax with the money. So we want this 2-year contestability in place. So if somebody has a serious health issue, gets diagnosed, unfortunately, in 2025, we're seeing all these turbo cancers due to unknown reasons, according to the medical
baffling.
science.
Scientists are
Baffling.
baffled.
It's absolutely baffling. Nobody knows why turbo cancers started appearing in 2021 and 2022.
Climate change, probably white supremacy.
Probably one of those things. But if that should occur 3 months after you started your contract and you pass away 4 months later, 7 months into the contract, they are going to withhold paying the death claim for a certain period of time while they do their due diligence to make sure that you didn't lie on the application. And they're gonna go back into the medical records, back into what's called the MEB. They're gonna do some research and say, did this person misrepresent their health? And we didn't find it in our original background check. Because if you had been diagnosed with cancer, or you had ailments that showed potential for cancer, or you had a cancer scan coming 2 weeks after you signed the contract, knowing you were having possible issues and this was a possibility, like, they want to look back and they don't want to pay that death claim because that affects every other owner of the company, which you are a part of in a mutual company. And in a stock company, it still affects everybody. It affects the bottom line of the company. It affects the stocks. So it's equally detrimental to those companies, but we're always thinking on the mutual side here. So as an owner in a mutual company, we like this contestability clause because then me as an owner can't be affected by Hans lying and dying. Yeah. And I don't want that, because that hurts my bottom line and every other owner's bottom line. So the contestability period is a good thing. It's an extremely good thing. Anyway.
And this is not to say that, like, if they challenge it, that it's going to be just no payout at all. Because again, it comes down to what would you had done have you known this information. So let's say, for instance, you said you're not a smoker. You somehow, if you say you're not a smoker, but then you pop positive for nicotine on the urinalysis, like, you're going to get tobacco ratings. But let's say somehow maybe you stopped for enough time for clean urine, and you said you're not a smoker, and then you went right back to pack a day, right? And then you die from lung cancer. So they look into that and they say, hey, we can prove he was a regular smoker. I don't know how he got past the urinalysis, but he did somehow. But we have the receipts. He smoked every day. They might not. They could, in that case, theoretically say, like, this was actual fraud, and fraud is one of the reasons that they can void the contract. But they would likely say, hey, it's not that he wouldn't have been insurable. It's just we would have given him tobacco ratings. And so instead of this, this is a $500,000 death benefit at non-tobacco ratings, but it might be a $200,000 death benefit or $250,000 death benefit, whatever, at tobacco ratings. And so we're still going to pay, but we're going to pay what we would pay had we known the truth, had you actually represented yourself accurately. And so that, and you made a good point that we want this in there because we want these companies to be stable. If we have a company that is just taking on all kinds of risk, like, I don't want that in the company that I own as a stockholder or as a policyholder, in our case with a mutual company. Like, nobody wants that. We have to, there's this idea that, a company making money is a bad thing if it's at the expense of, quote, the people, whatever. Like, no, capitalism is a good thing, and we want these companies to be profitable. And so it's not just like every time an insurer challenges a case, it's not inherently a bad thing. We want to avoid this pattern of, and this is where the protection of the policyholder and the protection of the insurer, both parties to a contract, are balanced by this 2-year window, because you don't want them to be able to indefinitely, 20 years later, still be withholding a death benefit when they could have done their due diligence or whatever. Like, you want there to be a period after a certain point where it's like, all right, this is just going to pay out. And that's on the policyholder side.
And it's actually pretty quick. It's actually pretty quick. Like when they contest a policy, it's not something that usually runs on for months and months and months. Like, that is a high priority item for them because they want to pay this death benefit. They're legally obligated to do so, but they just do their due diligence. And like you were kind of alluding to, one of the major points of failure for an insurance company, besides things like undercapitalizing, having insufficient like reserves and things like that, but one of the major things is poor underwriting and a poor claims management. So a lot of, like, there are companies right now that have really beefed up their accelerated underwriting guidelines. And I
Yeah.
mean, like they'll issue policies in a day or two. It's like no underwriting policies, go, 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 go. And it's kind of crazy. Like I kind of don't like that. I like working with a company that actually does proper underwriting and properly like assesses the risk of the person applying, because it's better for our profitability as owners of the company. It's a shame for the person that wants insurance and maybe can't get it as a high of a rating as they'd like, or they can't get it at all. But it's the nature of the beast. You know, that's the bad thing about this is the best time to get life insurance is today, because you have no idea what your health's going to be tomorrow. But anyway, I kind of cut you off there, and it just something you said that triggered those thoughts.
Yeah, I think that's about it on the incontestable clause. There's a few other things like misstatement of age or sex. If you said you were 45, but they found out you were 43, your death benefit would go up slightly. If you said you were 44, but they turned out you were 45, it would go down slightly. Like that's not something that has the 2-year cap on it. That's always going to apply because that's just basically a rounding error at that point. But those are a few other elements of the contract here. To go back to the start, what a policy is called an aleatory unilateral contract of adhesion. So those things are important, even though it sounds like kind of just legalese. But the unilateral one, I think, is one of the most important elements of this, and that is there's only one party in the versus compared to a bilateral contract. In a unilateral contract, only one party is legally obligated to perform. And so you have to pay the premium as a policyholder, but you're not required to pay the premium. You can just stop paying. If you pay the premium, the contract must be adhered to by the insurance company. So they're the only ones with the legal obligation here. So technically the verbiage that I've got, the insurance company is the only part of the contract which makes a legally enforceable contract. The policy owner's payment of premiums is technically a condition precedent to the insurer, or precedent, I think is how he would say it in this case, to the insurer's liability. The policy owner makes no promise to continue paying premiums, and there's no way the insurer can require the policy owner to continue paying premiums. So this is a unilateral contract. And then we've also got aleatory and a contract of adhesion. What is an aleatory contract?
Well, that's just the insurance company's promise or guarantee to pay the premium as long as you've upheld your side, or I'm sorry, to pay the death benefits, to pay the claim, as long as you've upheld your side of paying the premium, which is not contractually guaranteed. So in exchange for you continuing to pay your premium in some way, because there's multiple ways to pay your premium, doesn't always have to come out of pocket. If you have done that, it's the company's guarantee to pay the claim upon the necessitated event requiring that payment, death in this case.
And it can be something where the contract doesn't actually pay out. So the opposite would be a commutative contract, where you're basically one thing happens and the other thing has to happen, and these are a mutually valuable exchange. The example is I go and I pay $500 for a sofa. I get the sofa for $500. We've exchanged an equal value, and they happen essentially simultaneously. Whereas aleatory contracts, the payout doesn't actually have to happen, as in a term contract, right? So that's an aleatory contract. I make my premiums, but if I outlive it, the company doesn't have to pay. And so the other element of aleatory, and from what I can tell, they're both part of the same term, aleatory contract versus the commutative contract. But it's also the element of not equal payouts. And so the example, if I pay $500 for a couch, I receive a couch worth $500. That's different than if I pay $500 for a term policy that's worth $1 million. Or I buy a block of lottery tickets and I either win or I don't. If I win way more than I put in. If I don't get anything. And so that's a difference in the magnitude of the contract as far as what each side is bringing to the table. The final one is a contract of adhesion. And this one is the one that's most important for what we're talking about right now. Like unilateral and aleatory are good to know. They're elements of what type of contract a life insurance contract is. But the contract of adhesion is important, and you should remember when I said that the assumption is that the policy owner is the lesser informed versus the people that wrote the contract. And so the adhesion is the legal recognition that the policy owner was not in a position to negotiate with the insurer on the terms of the contract. The document's not evidence of the normal give and take negotiation and bargaining found in the standard contract. And this is a carve out of insurance where like contract law is enormous, and it's fairly like it's been fleshed out over centuries to where it's very well studied, right? And our entire economy is based on contract law, right? If I'm going to send money to someone I don't know in another state, I'm expecting I'm going to get those goods, and contract law is what facilitates that and gives both sides the comfort of dealing with unknown parties, right? So contract law is vital to everything in the economy. But typically when we talk about a contract, it's like we're both going back and forth on this house contract. We both are assumed to have equal knowledge. We make a decision, and the market price that we set is what the value of this contract is. That's
and we can
different here.
negotiate the terms in a standard contract. Even almost anything else you do, even purchasing a vehicle, you can negotiate some of the terms of that. It's more of a sale than a contract, but yeah, you don't get to negotiate the terms of the insurance contract. So that's a part of that.
Yeah.
It's a one-sided. Let's say the verbiage and the terms of the contract are one-sided. They're determined by the insurance company, and you are agreeing to them or not. And if you don't agree to them, there's no contract.
Right.
So, and it even states here in the definition, because the legal terms of the life insurance contract and underlying mathematical assumptions make it difficult for the policy owner to understand. For these reasons, courts will not insist that the policy owner meet the same degree of strict compliance to the terms of the life insurance contract as it might in the case of the typical agreement. So insurance contract, like I basically just said, is take it or leave it. Like you don't get to negotiate separate terms individually of the contract. It's just handed to you. If you agree with it, you sign it and start the policy. And the insurer selects all the wording, no negotiation of those terms. And the ambiguities are typically interpreted in the policy owner and beneficiary's favor against the insurer because of that fact that it's a lot. You are stuck in this little barrier, these really tight guardrails. This is what it is, and this is what you accept. And if there is a high likelihood that you may not understand every single piece of that contract. So the courts usually rule in favor of the policy owner beneficiary.
Yep. If you've heard the phrase caveat emptor, buyer beware, that's not applicable here to the same degree that it is in most other contracts. If I go buy a couch from Amazon and it's like, well, the couch turned out to be cheap and it was made in China. It's like, well, it says on there it's made in China, so you can assume, it's like buyer beware in a lot of cases is gonna hold, but that's not gonna hold in this case because the assumption is that the insurance company has professional underwriters, professional contract lawyers, etc., drafting these contracts, and then that one packaged document is offered to you. Yes or no, do you accept? So when you are choosing to sign that contract, you are not just forfeiting all of these rights to the company that is going to be trying to claw them back from you. Like it's just not how it works. And you can look at book after book after book of precedent for this, and it's almost like insurers know how much of a burden they have to face in court when they're trying to void a contract. And again, we're talking about life insurance here, because the more you add back onto the consumer as far as risk goes, for instance, an IUL does not have any of these protections. An IUL, the contract is so much larger because so much of the risk is put back on you. Mm-hmm. And so in that case, IUL, I think caveat emptor would likely apply because, hey, yeah, there's a lot of the risk of this falling apart, and we put it in there. If you read an IUL contract, it's in there. There's a lot of things that could go wrong that you sign to, that you are assumed to know, and that's part of what the product is. That's inherent to the structure of the product, and so
and they probably will go wrong.
Yeah, and we're relegating this conversation. Yeah. I mean, I'd say, yeah, I'm not gonna make up a number, but most of them will go wrong. And so when we're talking here specifically about whole life insurance, and term insurance falls under this umbrella as well. It's just your contractual rights are the same here, but the application and the value, the utility is a lot different, of course. But just when we're talking about life insurance, we're talking about whole life insurance primarily. So that's kind of some of the overview of the life insurance contract. There's a lot more to it. There's a few things that are required within the contract. That is, one is the entire application has to be in the contract. Because again, if it does get challenged in court, they're going to say, these are the representations that were made. Now here's the bar we have to set depending on XYZ to avoid this policy. There's also a grace period that's required to be in there. The states govern the regulation of life insurance. Each state's a little bit different, but there's a lot of things that are are applicable to most states. And there's a couple of, any of these things we're talking about, there's one or two states that have an exception or a different verbiage. But for the most part, all of this is regulated by the state. So when you see a contract, each one's going to be a little bit different if they're in different states, because they're going to have their own little blurb that's put in the middle there, like Virginia specific rules about life insurance contracts. But the life insurance contract is given its own body of judicial review because of this element of it's not this, because of that contract of adhesion element and the expectation that the insured is less knowledgeable. So there is a big body of legal precedent that protects you as a policyholder that you should feel comfortable with this. And we'll wrap up with just a few of the reasons why is it that they haven't gone like no policyholder has been defaulted on in a whole life contract. We'll hit on a few of those because I know that that's not necessarily the contractual element of it, but to get back to the question that she was asking is, why are they so wealthy, and what's to prevent, again, these contract elements are to prevent you from being, scammed out of your money in this case. But a couple of the reasons why, let's just talk about some of the reserve nature and some of this kind of safety nets you have. You know what I mean?
Well, you kind of mentioned reserve, and one of the things that the company has to do. Well, there's a lot of things. It'll just keep triggering thoughts about it, but on the reserve side of it is, as we've talked about at length on this, the policy builds a cash value, which is like an equity. It's the net present value of that future death benefit that they're expecting to pay out based on the mortality tables at some time in the future. So you have this cash reserve or this cash value within the policy. Well, the company has to keep certain reserves to make sure that that is always liquid. And a big part of that is going to end up being in claims. So they've also, the actuarial math of these, they don't know how many 40-year-olds, or they don't know which 40-year-old is going to die this year, but they have a really good calculation of how many will die this year based on their pool of insured. So one thing is they keep those big cash reserves. That's available to pay death benefits. That's available to pay in a form of a policy loan if you take it, which is why you can access that capital so quickly, because it has to come from the reserves, and it's used to pay death claims. But speaking back now to the number of 40-year-olds, the number of 41, 42, all the way up to 100 and some year olds that are still alive at that point, they know approximately how many are going to die, and they know how many of those are left on the books at that point and what the death benefits are on all those. So when the actuarial analysis comes, like we've talked about, one of the big investments of the life insurance policies is corporate bonds and different types of bonds. There's even some government ones and the different long range investments they do. But if I just stick to simplify this to say the bond market, they have bonds closing out every year already calculated in, knowing how much death benefit there's going to be from the general investment funds of the insurance company. So this year, for example, they might be expecting to pay $50 million in death claims across the entire country and their entire population of insureds. And they probably have approximately that number, or somewhere, plus or minus a certain percentage of bonds closing out this year. And the same will be true next year. So they're laddered in such a way that as all of the investments and the secure investments that they've done on guaranteed interest pays out, guess what? That's about what they're going to pay out in death claims. So it is so finely tuned within the companies, what's coming in, what's going out, where the investments are, and what the death claims are likely to be. That, the mathematics is fascinating on that and way beyond what I can ever calculate. But there's a couple reasons, they always have a new pool of money coming back from the assets at any given time. And a company who's done that well doesn't even see a blip in the radar, even with an event like COVID-19. They talked about that. And the little death surge that we had in 2020 and 2021, they were like, it wasn't even like a blip. It didn't even affect their bottom line when it comes to the money. What was considered, air quotes here if you're listening, mass casualty event, the insurance companies barely noticed it.
Yeah. If we think about what, she mentioned fractional reserve in there. So obviously understands the fractional reserve system of banking, where at any given time, whatever that ratio is that's required to be on hold, if more people than that, it's like we always use the example of 10%, but almost never 10% is the actual reserve requirement. But for simplicity's sake, when we say the 10%, for for whatever amount of outstanding deposits they have, they only need to have 10% of that on hand. And therefore, if everyone came to the bank trying to get their money, they don't have that money, right? Now, that element doesn't apply here because your current value, the cash value Brian mentioned, is required to be on hand. And for all the reasons he mentioned above, they're going to have that. We'll call that their current liability, i.e. if every single policyholder went and said, hey, I have my cash value is X, I want to surrender my policy, give me my cash value. Or every policyholder said, I want to take a policy loan. I know you have the capital there. I want the capital. I'm going to take, lend me against my cash value, right? Whichever one or whatever combination. If every single policyholder did that and said, we're going to wipe it out, that amount has to be on hand. So every policyholder is guaranteed that capital is there for them. That's your current obligation. Now we expand that to the future obligation, and that's all those death benefits. Now, do they have the money right now if every single person that owns a policy died? No, because that's part of the actuarial math, like Brian mentioned. Brian walked through in kind of in detail why they're going to get there, but right now they don't have to have that 100% on hand. If 100% of policyholders died, that company wouldn't be able to financially survive that because they have to have the current value on hand without any reserve, fractional reserves. They have to have 100% reserves on hand. But the future liability there has to be reinsured to 100%. So they have to pay insurance premiums to another company, a reinsurer, which is a much larger insurer, and not ones that we've typically heard of, but that a future payout amount that's in excess of what they currently have. If you think of just two circles, like the inner circle is what they need to have right now, and that's all that those pie slices are all of our cash values. They have to have that on hand. You expand that out to the future death benefits. And then your own policy itself is going to be like that circle is going to be your current cash value is going to grow eventually. And when you die, that death benefit is going to be paid out. Well, on net, we think of that larger circle as the sum of all the future payouts and death benefits that are going to happen. Well, that total amount, the difference between those two circles has to be fully insured with a reinsurer. So they're paying premiums to someone else. And they say, hey, if we start to get in trouble, let's say we have severely more death claims than we expect. Actuarial tables are getting wrecked here. That another insurer is basically collecting premiums, expecting not to pay them out because these companies, because of this management, because of how well managed they are, because of how deep their bench is, basically, this doesn't happen often. But when it does, if a company starts to get stretched, the reinsurer comes in and starts helping them out pay those claims to get them back to where they're solvent again. And so that's the second layer.
Or if the company just simply mismanages their funds, which is why we
Right.
have like relatively strict criteria of which companies we like to do business with. And the Nelson Nash advice that kind of was the foundation of us thinking about that was like the company should be over 100 years. He was giving that advice 25 years ago. So we should probably say they're over 120 years old now. They've always paid a dividend. They've always showed profits. They're A-rated, all these different criteria. When we look at the financial stability of the companies, we don't pick companies that are going to put themselves on loose, rocky ground. And that's by design so that we don't have to face that ability. But if a company, AIG wasn't in the life insurance realm, but that's the last large company that everybody's heard of that went under for a lot of mismanagement. So they would have had, let's just say for the sake of this example, if that was a life insurance company and they severely mismanaged their funds and they were about to go under, well, that's another time that reinsurer would have to kick in. If they were no longer solvent enough to pay the death benefits, the other company would have to, which is why one of the reasons that's one backstop for why these always pay. And then another backstop is the state guarantee funds that every single 50 of the 50 states has. So if everything continues to fail, now your state has to step in and cover the losses as a third place. And you even mentioned like if they're like they don't have the reserves to pay every single death benefit. And I like it, and you think about that like, well, what if that happened? Well, if that happened, like back to her first thing, we've just experienced nuclear warfare and your beneficiaries don't exist anyway. So there's nobody to pay them to. Like the chances of every death claim coming up in 2026 is either nil or there's no beneficiaries left either. So it doesn't matter. It's almost like a non-question.
And this all comes down to actuarial math, where how they're pricing these premiums, and they're saying, okay, Brian mentioned a 40-year-old male, standard rating 40-year-old male is non-tobacco. There's 10,000 of them that we have. 1.2 will die this year, right? Those are like the premium pricing for that strata of policyholders is priced with the expectation of the death benefit, how much it'll pay out and how long they'll have to grow the money, because in 5 years that 1.2 will maybe be 3.5 or whatever. And
Yep.
when those 40-year-olds are 85, it'll probably be of the remaining, 100 of them or 500, whatever, like of the remaining amount, maybe 70% could be expected to die at, down the road. Like it makes sense, just the natural course of life. The older you get, the more people that have died. And so they're pricing all this actuarial math goes into the pricing of how your premium is calculated, but there's also reserve baked into that. And when we talk about dividends, the reason that these companies can pay dividends reliably for over 100 years is because the two assumptions that they make create a buffer where the expected return on the growth of their portfolio is underestimated, and that's a conservative. So even if the market doesn't perform as or their investments don't perform as expected, they still have some wiggle room to still be profitable and meet that what's baked into the assumptions here. And on the other side, the death benefit assumptions are over generous, and so therefore, if more people die, it can push into that buffer without still creating this middle ground where they can still declare a dividend even if these assumptions don't make sense. And
What a
and
concept.
so
It's
yeah,
it's funny that people get like super excited about that. Like, you hear this stupid common phrase of like, oh, a dividend just means they charged you too much.
right.
Well, it's like, so building in financial redundancy to these people must be stupid. Like, how many of them would get on an airplane with no system redundancy? Like, redundancy is something that it's like baseline engineering. We want to build that into all the things we do in life that have a physical nature. That can present some sort of risk. Why do we have a side airbag now? At one time there were no airbags, and they said, hey, like, the seatbelt isn't quite enough. Let's put an airbag in, and let's put a side airbag in. We're building redundancy for failure of any of these other mechanisms. We always, us in the aviation world know that almost everything in an aircraft has some level of redundancy. And the things that don't are the things that kill people quickly. And so you want this redundancy, and nobody would get on an airplane where, like, if one thing goes wrong, it's going to crash. Like, you just simply wouldn't get on it. But like, when we talk about building these financial redundancies that they do, they overestimate one thing, they underestimate another thing to ensure profitability. The standard mantra out there by the financial entertainers is that they're overcharging you and you got ripped off. It's funny. It's like, I kind of like having strong financial redundancy in the place that I store my capital.
Yeah, and when I'm at retirement age and my dividend is larger than my annual premium by
multiples,
a factor of 2, like, how is that even? What are we even talking about here? Like, how am I overpaying at that point? And that if you take a 1-year snapshot, your first year of the policy, I could see that argument. Like, yeah, you overpaid, so therefore you're getting a dividend for what you overpaid. You could say that if you isolate it to 1 year maybe and make that case to someone who doesn't understand the contract. But when I'm looking 30 years from now, how do you even make that case when I'm my $50,000 annual premium and I'm getting a $110,000 dividend? Like, how do you even make that case? But when we talk about points of failure across your asset allocation from safety to risky, the more, like, the fewer points of failure should be on the risky side. Like, if you put all your money, for instance, in a crypto, or all your money in one stock, you have a single point of failure, right? The further you get towards your safety assets, which this is your saving and protection. This is where we want so many, mitigated points of failure in this asset, because the purpose of this is not to just get exponential returns and just year over year rate over. Like, we're not talking about that. We're talking about safety and protection. I want as few things that are like risks to this that can go wrong. And so we pointed out a couple here. We've got the 100% reserve for the current outstanding liabilities. We've got the reinsurance for the future liabilities. We've got the state guarantee association on top of that. We've got the fact that the courts are so firmly in your favor as a policyholder. We've got centuries of case law protecting policyholders to the point that they've had to change the contracts to accommodate courts just because they know how spring-loaded against the insurer the courts are. Like, everything we're talking about here should reassure you that in the asset that you want for your safety and protection of your family, as many things as we can remove from the question mark side, that's what we've done here. That's the purpose of this episode. That's the purpose of having this asset in your asset allocation model. I have crypto, I have investments, I buy stocks, like, I do all those things, but those are single point of failure items, and I accept that risk because I've been getting outsized returns. But if all that goes to hell, I've got this safety asset here where I've done all this due diligence, and the companies have the financial stability. They've got the reputation. They've got the deep, deep, deep pool of liquidity. They are some of the wealthiest companies in the world, and that's not a bad thing. That's exactly what I want when
awesome
I
thing.
die. Not if, but when. I want my wife getting the guaranteed tax-free $5 million she would get if I died today. I want her getting that from a company where that's not going to be in question. I want that deep pool of reserves. I want it to come from the wealthiest company in the world, not a company that's going to be like, should we challenge that? Because if we pay that out, it's going to put us in, no, that's not even on the table. Like, this is where we want that certainty. So I hope for our listener who had this kind of general theme of questioning, I hope that puts some of those concerns to bed. You got anything else on the contract, on just the safety of like
No,
much
I'm
safety
good.
in your safety asset?
No, I was just thinking about earlier. I wanted to say like the misstatement of age. Like, do you think that still happens today? Like Satchel Paige might have screwed that up, but does anybody in like modern America not know how old they are?
No, and I would say on it like now, because it's always it's misstatement of age and sex, and I would say for 100 years, no one's ever misstated their sex, and now
now they
this,
might
this
do
absurdity.
This, maybe the sex, but not the age.
That's what I was gonna say. Like, that's probably more likely now, and they're like, wait a second, you're a man. It's like, I don't care what you think, you're a man. Like, you're gonna get categorized as a man, and so I think this little blip of insanity that hopefully is passing. I would tend to say that the misstatement of sex portion of that is more apt today than the misstatement of age. But
if any insurance agent lets somebody misstate their sex, shame on them. They should get out of the business too.
Yeah, for sure.
Yeah, like if somebody tells me no, I'm actually a female, I'm gonna be like, you can't apply with me. You need to find somebody else to lie to.
Yeah, we're not.
I'm not passing on your delusion.
No. Yeah, we don't have like. I mean, we're pretty aggressive in what we believe, and we don't really shy away from that. That said, we don't have like an ideological purity test to work with us. I think the people that are strongly views are just inherently going to self-filter, but it's not like you have to believe what we believe to work with us and get policy in place. But yeah, like you said, if that's what we're dealing with here, I am not going to, because I'm not going to say you're a woman with an Adam's apple there on an insurance statement, because then I am committing fraud. And it's like, I don't care what, like, I'm not going to risk my license by outright lying in something that's obviously a lie. So anyways, and you're probably uninsurable due to mental health, I would guess, but that's
I don't know though, man. It all depends on how propagandized the company's been at that point. And then I don't want to work with that company either. So I don't know. There's all kinds of crazy shit going on out there right now that hopefully doesn't cross our paths whenever it comes to helping people put this amazing asset in place.
Yep.
All right, man. That's all.
All right. Well, if you want to talk through this stuff.
Yeah, I was gonna say, speaking to that, I'm gonna probably record a little solo because you're gonna be out of pocket for a couple weeks here, and I think I'm gonna do one on a little bit of policy design and where that money goes, how it affects the reserves based on what type of premium you pay, and how that affects the company long term. So expect to see that in the next few weeks as well. So we'll even talk about the way you pay premium and what that means to the long-term stability of the company, what that means to the long-term stability of your future potential wealth that you could draw from these policies when you're older. So, and that your family will get. So I think it'll be interesting.
Cool. Yeah, it's kind of a weird time travel. Like, it's sort of trippy to think like we're leaving in 2 days for Park City, but by the time anyone hears this, we'll already be back from the trip. So when you're listening to this, you're listening from the past, but I'll see you guys in the future. I don't even know if that makes sense. Like, there's some Inception level connection going on here, but when you hear this episode, I will have already returned from this trip. So it's kind of strange.
Please put this out there. We'd appreciate it, and share it with anybody that you think will benefit from this. And we look forward to chatting soon.
All right. Cheers, John.
Thanks for listening to Remnant Finance. If you found any value at all in this episode, please subscribe, leave a review, and share it with a friend.
Remember, true financial freedom comes from taking control of your personal economy and breaking free from the status quo. So stop being a passenger in your family's financial future.
Boldly take back control of your wealth. Until next time,
this is Brian and Hans signing off.